Okay, all right. It's your boy Crypto Blood. Welcome to another episode of My Two Satoshis. And we're rocking out to some old school 80s rock. My man Brian XV wanted me to play Sisters of Mercy, a rock in a hard place. Yes, I play it all, my friend. I appreciate the song request. And I hope all of you guys are doing well today. On today's episode of My Two Satoshis, we're going to talk about Monero burning bug. They had a bug too. All these bugs popping up all over the place. Actually, it's normal, and I'm really surprised there aren't more bugs, because this is, again, software at the end of the day, people. So bugs will inevitably be there, always, will never end. We just hope that it won't be a critical, crazy bug that takes down everything or allows people to really exploit things. Like now that we're seeing with this bug with Bitcoin, has actually been going on for about 2 years and been exploited for 2 years. So we've been having people double spend for 2 years now. Don't know who, but that bug has been available for exploitation for almost 2 years. But the Monero bug, they've patched it. They've got it fixed. They pushed it out to all the nodes, but they're saying that there are still some organizations that may be at risk. So we'll take a look at that. Secondly, yes, another stable coin. This time around is from the company Circle, and that's owned by Goldman and Sachs. So you can see, again, the trend. 2019 is going to be the year of stable coins, I'm telling you. And I had a debate with a couple of people on YouTube yesterday about just money. What is money? What's currency? And the funny thing is, people fail to realize, in my opinion, that your Litecoins, your Bitcoins, your Bitcoin Cash will never be a means of global payment system. It may be a means of settling stuff, transfer of wealth, but day to day, I highly doubt it. And the reason is because people are programmed to spend inflationary money, not spend deflationary money. And honestly, until that paradigm shifts, it won't be our generation, it won't be the generation after us. It may be a couple of generations after us that will get this, but we are in a debt-based system. And capitalism, I think, will only work in a debt-based system. So what I mean by that is, one example a gentleman gave me was that, yes, businessmen like to spend deflationary currency. And I said, well, it depends on which side of the transaction you're on as a businessman. If I'm a businessman that loans money, I do not like deflationary money, because I'm loaning you, I'm just going to say, this Bitcoin at this fixed nominal amount. So let's just say 1 Bitcoin, right? And in 5 years, you have to pay me back that Bitcoin plus a little interest. Well, guess what? When you pay me back that Bitcoin, I'm not getting 1 Bitcoin back. I'm getting the nominal amount back. So if I loaned you 1 Bitcoin at $6,000 today, when I get my money back, it's not going to be 1 Bitcoin. It's going to be $6,000 plus a little interest on it in 5 years, when I could have just held the Bitcoin if that was the case. It's a difference between money and currency, and I think we're conflating those ideologies, those ideas. And I'm telling you, stable coins are probably what you're gonna see in the future at your malls, at your gas stations, so on and so forth. They may accept Litecoin, Bitcoin, Bcash or whatever, but they're willing to accept it. I think consumers or the masses will catch on eventually and say, oh, I'm going to hold on to this, and it's going to be more of a speculative play. Not saying that these cryptocurrencies are going to go away, more so the altcoins. I think Bitcoin is here to stay for sure, but I don't think the altcoins are going away either. It's just that they won't be used as currency. They will be used as a means of speculating for as a digital asset. So we're going to look at both of these articles, but first, I know I was long-winded with that. Let's look at this market cap. We're at $215 billion. Bitcoin's dominance is dropping 52%. For the 24-hour period, we got a little bump. We had a pullback, actually, but it looks like we may be stabilizing for a minute. As you can see here, we did bounce off that line, as I showed you guys. But if we can't complete this ABCD pattern here and move back up, of course, the opposite of that is to head back lower, and we'll test this line. So Just got to kind of keep an eye on it. I'm a reactionary trader. I don't try to predict the future. I've learned over the years that is a recipe for disaster. So I'll keep you guys updated on that. The first article out of AMB Crypto, Monero's critical burning bug fixed, but developers say organizations could be at risk. It says here, a recent post by Monero official website stated that there was a bug in the wallet which could be used by attackers to send multiple transactions to the same stealth address, which were a predominant part of Monero's privacy. They would be used to authorize and request a sender to create random one-time addresses for all the transactions which were done on behalf of the receiver. According to the post, this could result in attackers intentionally burning the funds of an organization present in Monero's ecosystem. The funds can be burnt from any wallet without any additional cost except for the network transaction fee. Wow, this is crazy. However, the attacker does not have any direct monetary gains but might benefit from the attack indirectly. Sending multiple transactions to the same stealth address to burn the funds of a user is not something new, and there has been recorded evidence of its existence for quite some time. The consequences of an organization being involved was not thoroughly thought through until a community member described a hypothetical attack on the Monero subreddit. The Monero community stated the numerous duplicate key images can be generated by sending XMR to an identical stealth address. The network then declines the key image as it is already available on the blockchain, and it will recognize an effort to double spend. The official post further stated that attackers modify the code to get access to a particular private transaction key. This allows the stealth address to receive the same multiple transactions sent to the public address. The attacker could then send 1,000 transactions of one XMR to any cryptocurrency exchange. Since the exchange wallets are not aware of any particular abnormality, they will credit the attacker with 1,000 XMR. Thus, the cryptocurrency exchange are left with 999 burnt outputs of one XMR. However, the community confirmed that the bug did not affect Monero's protocol and the coin supply was not affected. According to a recent post, the Monero wallets on major exchanges like Poloniex, Bittrex, Cryptopia, and XMR.2 were not functioning. So there you have it. It's been patched, but there are still individuals or organizations, I should say, severely exposed to this. If you guys don't update. So, you know, let me know your thoughts. What does that mean, man? Again, I always tell you guys with all the privacy coins, like, what if there's a bug in the future that allows the NSA or the government to exploit and expose any transaction on any of these privacy coins? This is what I mean. Like, in theory, these privacy coins are excellent, but nothing is for sure. That's why I kind of have an issue, or not an issue, but I'm hesitant about these privacy coins, and it's not the team's fault or nothing that they've done. It's just that there's always that inherent risk of possible exploitation of the code because we're human. It can always be a vulnerability in the protocol, in my opinion. Is it ever caught? Is anyone ever able to find out and exploit it? I don't know. But there is that possibility, and you know, you run that risk. But yeah, I just wanted to let you guys know about that. The second article is out of Ethereum World News, and this is the one I wanted to really focus on. Circle's CEO says we can rebuild the global economy system with USDC stablecoin, they say. Is that right? Crypto startup Circle finally launches in-house stablecoin. Circle, a Boston-based cryptocurrency-focused startup, has hinted at its plans to launch a stablecoin currency for months on end, divulging that it had partnered with Bitmain to issue a USD-backed crypto asset in May. I remember Circle, actually. You guys may not know, but I think I was using Circle before Coinbase even got around. You were able to buy right from your phone. They were one of the first ones in the US to allow you to buy cryptos right from your phone using a debit card or linking it to your bank account. Really good interface. But then like a year or so ago, maybe a year and a half ago, can't remember exactly, but they said they were done with that, and you can only use their products and services to move and pay people who had Circle accounts, which is counterintuitive. But it looks like they're kind of getting back up to speed and looking like they're trying to go the way of Coinbase. So again, Circle was around, I think, before Coinbase, and I think I was using them before Coinbase was even in existence. So the article goes on to say here, finally, after months of development behind closed doors, the firm released an announcement via its official Medium blog to tell this nascent industry that its stablecoin, dubbed USDC, is ready to hit public markets near you. Per the announcement, which was short but sweet, the firm explained that USDC is a fully collateralized US dollar stablecoin which will allow investors from both institutional and retail backgrounds to deposit USD dollars in exchange for USDC at an exchange ratio of 1-to-1. Explaining the specifics of this venture, Circle revealed that the USDC is an ERC20 token which allows for the firm's operations to stay transparent and in line with regulatory framework imposed by global governmental bodies. It was also noted that this is the first fiat-based stablecoin that has been developed by Centra, the open source project and membership consortium that has plans to launch similar products in the near future as this space develops. Starting on Thursday, traders will be able to utilize USDC on the Poloniex exchange, which Circle owns, as an alternative to Tether. Speaking with Business Insider, oh, here we go, Business Insider, on the matter, David Allaire, the CEO of the startup, explained this venture into the stablecoin sub-industry, highlighting his firm's aspirations for the move. Allaire first pointed out that fiat token models are integral to blockchain infrastructure, as stablecoins will likely enable the use of decentralized technologies from tokenized debt and lending to securities and investment contracts. All these things are so powerful. In short, the industry leader noted, it's really a fundamental building block for all of the excitement that exists around crypto. But I think the next layer, and so much of what we're excited about, is how this becomes part of the broader market infrastructure that's needed to rebuild the financial system on top of crypto, which is what so many of us are here for. Following the aforementioned implementation into Poloniex, crypto exchanges like OKCoin and CoinEx, along with wallet providers like Coinbase, are expected to introduce USDC support over the next few months. Due to the fact that Tether is problematic, as put by Allaire, it only makes sense for firms to continue to strive to create a stable product that can be trusted by individuals across the world. Despite this news, which many saw as a strong step forward, there were some skeptics who claimed that the stablecoin subsector is starting to become overpopulated and crowded. Simply put, even prior to the announcement of the public release of Circle's USDC, Travis King, a former portfolio manager turned crypto hedge fund manager, explained that dozens of stablecoins that currently exist are overcapitalizing attractive areas of investments so much that they have become bad investments. And this is what Travis said here. Crypto overcapitalizes attractive areas of investment so much they become bad investments. He says, oh, exchanges make money? Cool. Here's 250. Oh, USDT has 30 billion market cap? Cool. 40 stable coins. Oh, fat protocol thesis? Cool. 6 billion for hash graph. Oh, mining is profitable? Cool. 4x difficulty. Article finishes up by saying, interestingly enough, this news only comes a week after two similar products were approved by a prominent New York regulator, which likely led the aforementioned Travis King to issue the tweet seen above. Yeah, listen, we only need one stablecoin. One stablecoin for each of the fiat currencies out there. Like, I don't understand. I agree with them. Like, you don't need 20 different stablecoins. It's only going to be one that's necessary. They do the same thing. They peg and allow people to buy and sell crypto assets and have it pegged to a fiat currency. So you guys let me know, why are there so many stable coins? Which one do you actually think is going to be the one that's the top dog? I don't know, man. I don't know. I just don't see a reason to have at max two, because you may have two companies that end up going out there and building partnerships and relationships with different individuals or organizations, I should say. And you know, you may have the Coinbase side and all of their buddies, and then the Gemini side and all of their buddies. So we'll see what happens here, people. But unfortunately, what many of you thought, and even me up until probably late 2017, middle of 2017, I started to realize, like, hey, this is not Bitcoin, Litecoin. They're not going to be used on a day-to-day basis. A deflationary currency just doesn't do well with day-to-day commerce like we envision it. It's got to be something either stable that's pegged to a inflationary fiat currency, or the crypto has to be inflationary. It's just the way it is. Economics 101, people. It's your boy Crypto Blood, and that's my 2 Satoshis for today. I'm out of here. Holla!